Syndication made easy. This is with Mr. Vinney Chopra. I am your co-host, Alicia Debrell, and today we have a repeat guest, Ted Lanzaro. How are you doing today?
I'm doing good. Thank you so much, Alicia, for having me on. Thank you,
Hi
Vinney.
there, Ted. Good
How are
morning.
you?
It's such a pleasure, brother. Thank you so much for coming on the show. I really appreciate that.
Always my pleasure.
Oh, well, let me go ahead and kind of introduce Ted. Ted is from Connecticut. Ted is a certified public accountant, a real estate investor, real estate broker. Like me, I'm also broker, and author and speaker with over 29 years of real estate tax consulting and investing experience. That's tremendous. He runs Lanzaro CPA LLC, a boutique CPA firm specializing in accounting and taxation for the real estate industry. For the past 29 years, he has helped thousands of real estate business owners, entrepreneurs, and investors all over the United States implement cutting edge tax strategies. And that saves them thousands of dollars annually on their taxes. Welcome to the show, Ted. It's such a
Vinney,
pleasure.
thank you.
I am
Yeah,
so excited about to have you here. And
awesome.
and again, I'm your host right here from San Francisco. It's pretty sunny out here. Alicia is in Texas, my co-host, and Ted is in Connecticut, and his company's there, but he works with everybody around the country. Today's title, we want to give that, guys, so that you can really get absorbed, get your pen and pencil ready, and take some notes because we'll be sharing some great nuggets. And Ted is going to drop them, those gold bombs, we call it, how to keep more of your own money legally in 2020. That's the topic. So, Ted, tell us a little bit background about yourself and how you got into real estate tax law, accounting and CPA, tax, all that strategies.
Yeah, when once I graduated from in Florida at the time, and I joined a C firm there in 1991, career in public accounting, a lot of the economy of South Florida was essentially construction and real estate. So I lived down there at a time where they were literally building out a lot of what went from being like a kind of a sleepy little East Coast between, say, West Palm Beach and Miami to now being this huge metropolitan area, and they were building all of that out. And so I immediately got involved in the real estate industry because that's really what there was down there, and a lot of our clients were either in the construction and real estate industry or both. And it was a time when there was just tremendous growth in that industry. And so I worked with a lot of developers, shopping center owners, apartment building owners, and back then we used to do a lot of syndication work, a lot of syndicated partnerships. But at the time, a lot of those were more shopping center based. Mm-hmm. and office building based. So it was really kind of very interesting how things have changed over the years. Now, around 2002, a friend of mine approached me, and he's like, I've been thinking about getting into real estate investing, and I want you to read this book. And the book was Rich Dad, Poor Dad by Robert Kiyosaki, right? Who hasn't read that
book?
Right?
Yeah.
So I said to him, I said, honestly, I've been thinking about the same thing. I work with these investors all day long doing their taxes, and I see how much money they make. I said, this is not a bad idea. So we decided we were going to form, with a buddy of mine from high school, we decided we were going to form a real estate partnership. And we started, first day out, we went out, we made 3 offers. We bought 3 single family houses down in Fort Lauderdale, Florida, put contracts on them, and, ended up fixing them up and renting them. And then over the next year or so, bought 3 more, bought a small apartment building. And what ended up happening was I started, as we were looking for more properties and looking for people to work with, I started going to real estate investment club meetings, right? And there were people in South Florida at the time. And one of the guys who ran one of these clubs found out that I was a CPA, and he's like, "Well, do you think about the tax strategies for real estate?" And I said, "Yeah." I said, "I've been doing this for a while. I just got started, in the last couple of years, but everything that I've learned, I've been using for my own portfolio." And he said, "Well, would you mind giving a presentation to the group?" And I said, "Well, I've never done that before." And at the time, I really wasn't. Now I do, speaking appearances off the top of my head.
You're all over.
2 or 3 a month, all over the place. But
yeah.
But back then I had never done it before. So here I am, literally standing in front of the room, with a PowerPoint presentation that I'm literally reading off of, while my knees are like knocking together, right? And when I finally got to the end of it, right, big applause, and everybody had learned a lot, and a lot of people wanted to do business with me. And I was like, wow, this is really a great way to share knowledge and build a client base. So from there on in, I really started concentrating on just being a real estate CPA, because I saw that there was a huge opportunity to really share what I knew, what I loved, and also build that into a niche business.
Sure. Fabulous. No, that's very, very exciting to know how you got started, So share with us, can you tell us the tax smart? Oh, by the way, I want to let audience know you have written a great book. Do you happen to have a copy of that? Can we show it, please? Oh, look at that.
We'd love to see it.
Landlord, right there. Strategies for landlords to save thousands of taxes, each and every year. Hey guys, please pick that up in, Amazon. It's available right there. I would highly recommend. Please get a copy, from right there. So thank you for sharing, Ted. Appreciate that. Can you tell us, what made you write that book?
So, you're a big, think about it from this standpoint. I had always, I've been working as a CPA. I had all this knowledge, and from my investing career. So it was kind of a combination of investing knowledge and tax knowledge. And I was listening to a webinar or a podcast, and they were talking about, thinking bigger and serving more people and this. And so I really started thinking about that. And I said, well, how can I, bring more value to more people, right? Sure. So I was like, you know what, let me write everything I know into a book for investors, right? And so that's sort of how it got started. And it was the first time I did it, honestly, it took me actually a couple of years to compile the information.
It took me 2 years also. We are on the same page.
Yeah.
To share, the knowledge. You're right. Totally.
Yeah, because it's actually, it's hard work to write a book, right?
It is.
Very hard. Very hard.
And the first time I did it, so it took me a couple of years to put it all together, and then, get it edited and get it, into a publishable format and all of that kind of stuff.
Yep.
And, but I really felt like I was sharing, the best of the knowledge that I had, the things that I was doing with my clients, sharing the stories, sharing the success strategies that we were using. And one of the things that we talk about in the book that we'll talk about a little bit today is, tailoring tax strategies to individual people's circumstances.
Please.
Yeah.
It'd be amazing. Let's do that. I really am looking forward.
I was just going to ask you, you're like a few sentences before me that I was going to ask you, what is tailored tax planning? You know what I mean?
Yeah.
And how does that work for an individual?
Right. So the book is basically, the first few chapters talk about how we want to take advantage of the tax laws, right? Mm-hmm. But not every strategy is a great strategy for everybody. It's not a one size fits all kind of tax strategy world, right? Mm-hmm. And so what it really comes down to, when I talk to groups of investors, what I tell them is we're all different. We all have different things that happen in our tax situation that have to be addressed in order for tax strategies to be workable. So what might be a good strategy for me, Vinney, or for you, Vinney, might not be a good strategy for me, or might not be a good strategy for Alicia. And the reason that is because of our unique circumstance. So it comes down to, are you like different things, different criteria? Are you an active real estate investor? Are you a passive real estate investor? Can you qualify as a real estate professional? And we'll talk a little bit about that later. What's your income? Are you a W-2 employee? Do you have a business? How much? What are your goals? How much are you putting money away for your retirement? Are you married or single? There's a whole bunch of, how many dollars a year do you earn? All of these different things have to be factored in order for a tax strategist like myself to proactively assist investors to save the maximum amount of dollars every year. And the other important thing to remember is not only are we all different, but we all have to look at our situation proactively during the year and not just after the year end, right? So my practice specifically, so what we're talking about today, how to save money legally in 2020.
Yeah.
Right?
And
starting today.
We're in March. Right now, it's the best time to really have a strategist like Ted or somebody near. Yeah, exactly.
Yeah, so we're gonna. So 2019 is over, and we're still helping people save money on their 2019 taxes with what we can do for them now, post end of the year. Yeah. But all of 2020 is still wide open to put a lot of different strategies in place during the year, right? And I always tell investors, I want to know when you're buying a property, selling a property, renovating a property. And we're going to talk right before year end, because those 4 events are where all the value in year end tax planning and during the year tax planning, proactive tax planning comes from. So if you're renovating a property, I have a set of tax strategies for you. If you just bought a property, I've got a set of tax strategies for you. If you're selling a property, I've got a set of tax strategies. During the year while you're holding properties, there's a different set of tax strategies I want you to implement. And not only just the strategies, but the documenting of the strategies, so that the things that you're using are going to be as documented and as bulletproof as possible when you go to file your taxes. And one of the things we talk about is that I hear a lot in my when I do speaking engagements is my accountant is really conservative, right? People say that all the time, right? And the reason a lot of accountants are really conservative is because we know a lot of our clients are really bad record keepers, right? And if you're a really bad record keeper, then we don't have any choice but to be conservative, because we know that if you did get looked at, you wouldn't have the documents necessary to defend yourself, right? So not only do I teach strategy, I teach documentation, because documentation and good record keeping is the foundation that good tax strategy is built on.
So true. So very true. Exactly. So if you were, like if some individual wants to come to you, right? So what will be the steps? Would you send them like a questionnaire and all, or like, if somebody listening to us, they say, oh yeah, I do want a better strategy for 2020. Where should they start, and what would you need?
Yeah, I mean, look, most people either contact me over my website or through Facebook, or they just simply find me on the internet and they call my office. It starts with that initial contact. Hey, I'd like to learn more about how to save money in 2020. Awesome. What I then do is I literally send you a link. You set up a 15-minute phone consultation, and we talk about either on Zoom or on the phone. We talk about, and I learn about your individual situation, right? So I'm gonna say, do you have a W-2 job, or do you have a business? How much money do you make? How many properties do you own? Are they new properties or old properties? That sort of, the more mature property is, the more likely somebody is to have more net rental income.
Equity,
right? Yep. Are you in syndications? How many? Are you a limited partner, a general partner? So I learn all about that person's situation, right? And then I say to them, look, based on what I've just learned, here's where I think I can help you, right?
Yeah.
And then we start, and then typically I would send them a request for, send me your last year's tax return, send me your whatever, if you bought a new property. So depending on the situation, let's say they had just bought a new property, I might say, send me the closing statement.
Yeah.
Let's take a look at it. Here, let me send you some information so that you can kind of give me a rough idea of what kind of building it is, what's in the building. If it's an expensive building, I might and a cost segregation study.
Yep.
If it's a less expensive thing, I might give them the tools to do their own kind of like conservative cost segregation. Just do some breakout, like on a 3-family house that costs $200,000, for example, where you wouldn't be able to get an engineered firm out there to do it. So I teach them how to do the basics of it, so they can still get some of the benefits. And then we just look at all of these different things. When one of the real benefits of being an investor myself is when people are renovating properties, right? And I can actually talk to them about whether it doesn't matter whether it's a 3-family house or an apartment complex. I can talk to them about what are the things you should be doing to get the maximum depreciation out of that building during the renovation, and also keeping track of the things that are getting thrown away in the renovation because you paid for those things, so you're entitled to a write-off on those. So all of these different strategies are things that when people contact us, we learn more about them, and then we start to match and tailor the tax strategies. Like a tailor puts together a night for somebody, we start to tailor the strategies around their unique situation and teaching them how they can use the tax laws to save money based on their portfolio.
Beautiful. Now, in your career, you suggest the investors come into as a limited partner or general partner through S corporation or C corporation or LLCs. What's more beneficial? Would you like to throw some light on that?
I mean, look, it all depends on what business you're running. So again, it's not a one size fits all kind of thing. So people, I'll give you an example. I have a guy who comes and he says, look, he says, I'm good. I'm a general partner. I do capital, find buildings and do this kind of stuff. So I'm essentially on a syndication team. And for that, I'm going to get acquisition, right? For bringing my capital and doing my business. So he says to me, should I be an LLC or an S corporation, right? Now the difference between an LLC and an S corporation has to do with the amount of self-employment tax, which is basically Social Security and Medicare tax that you pay on how much of the income you earn. So if the difference is on an LLC, you pay self-employment tax on 100% of the income. In an S corporation, you pay self-employment tax on the salary part of your income, and you don't have to pay on the rest, the draw part. Okay, so say $100,000 of net income as a syndicator in an LLC, you're going to pay $15,000 in self-employment tax. In an S corp, you're probably paying more like $7,000 or $8,000. So there's a big difference in there's a big difference in the spread and how much self-employment tax you would make. Now, the difference could be though, so there's other things that go into that, right? So when you're talking about that analysis, you have to look at a few different factors. So let's say it's a single member LLC, right? It's just one person who's running this company. Now, if they convert to S Corp, they have to file a separate S corporation tax return, right? Well, that costs money. That would probably cost, say, $1,000 to do in my office, file that separate return. They also have to go on payroll because in an S corporation, you have to take a reasonable salary, right? So you have to go on payroll. So that's going to cost you a little bit of money to do, right? So now the question becomes, am I better off as an LLC or am I better off as an S corp? And that there's no one size fits all answer to that question. That is looking at each individual person's situation and saying, you, Vinney, you're better off being an S corp. You, Alicia, you're not better off being an S corp. Why? Well, maybe you want to put away the maximum amount of retirement contribution that you can. And in an S Corp, you're limited to a 401k at say $19,000. In an LLC, I might be able to put away $55,000.
55. Right? Yeah, I was going to
say.
Right?
55, 56. It might even be up to 58 now, whatever it is. It's 20% of your net income up to a certain limitation. So if you're somebody who's making a lot of money and want to make that max contribution, well, that may be a different entity type than somebody who is like, well, I'm just going to make my X amount of and put away my $19,000 and then I'm done with it. I don't need to put away anymore, right? Okay, so that's maybe the difference between whether I recommend an S Corp or recommend an LLC for you to run your business. So self-employment things is really important, but it's not the end all, right? So it's not. It's so. And then then I might deal with another person who's like, well, you know what? I have a situation where I'm only going to make $50,000. Okay, well, you know what? That's a different story. Maybe you should stay as an LLC. There's not enough benefit there for you to pay for the extra tax returns and payroll taxes and all of that. So that may be, and then you have another person who's making 250 and it's the exact opposite. You're like, wow, you're going to just blow it out of the park by doing this. You're going to save so much money that you absolutely have to be an S corporation.
Yeah.
Right?
Thank you.
Yeah.
Wonderful. No, that's wonderful. Also a lot of our investors are limited partners in the LLCs that we syndication, we do. I've done 28 of them so far and, it's been tremendous. So limited partners and then general partners, of course, then limited partners like doctors, attorneys and all, they are working hard, but they're putting money. How are the tax ramifications like the K-1s we give out, right? Would you kind of like to explain how they can utilize their what is called passive loss, right? Accumulated passive losses, kind of how it can go in the future. And when we sell the properties, they can kind of mesh them together. And then also, I know a lot of people listening to us would be saying, okay, how can I active and passive income? What are the differences and how I can become a real estate professional? That's the other, I'm sure you've been asked that question many, many times,
Yeah, and that's part of, so for each one of those, there's a separate group of strategies that we implement for planning, right? Now, for the strictly passive investor, the doctor who is literally working, 2,080 hours a year, he has no chance of qualifying as a real estate professional. His wife is not interested in being a real estate professional because that's one of the criteria we'll talk about a little later. Your spouse can qualify, for example.
Yep.
So in that scenario, what we're doing is we're saying, look, enjoy you're a passive investor. You're getting cash flow from your investment and it's being offset with depreciation. You're getting tax-free cash flow. So that's number one. Good. Now, you never lose the carryover. So when you get the tax loss on your K-1, if you can't take it, then it carries over. Now, here's some ways you can take it, right? Let's say I already have we were talking before about having a much more mature portfolio.
Yeah.
So if I'm somebody who has a more mature rental portfolio that's throwing off net rental income every year, right? And I know I have a lot of clients like that, right? They've been in the real estate business for a while. They've already taken the depreciation up front on a lot of their properties. Maybe their properties are 15, 20 years old. Their mortgages are starting to get paid down. They're showing that income. They have no way not to, right?
Yeah.
So now the syndication loss can be used to offset all of that net income from their other portfolios, from the rest of their portfolio.
Income. So passive income from one asset can be offsetting passive income from other assets.
Yes, a passive loss from one entity can offset passive income from the rest of your rental portfolio.
Beautiful.
I love it.
The other thing that we can do is we can use the cash flow to make sure that we're maxing out our 401k or retirement plan contributions at work. Maybe we're living on our income. A lot of people are like that, right? And so we use that extra cash flow. We don't necessarily get the deduction against our ordinary income just from applying the K-1, but we can take that cash flow and we can use it to make our retirement plan contribution. And then we're getting a deferral, we're getting a tax deduction.
Yes.
It's not the passive loss deduction, but it's a retirement plan deduction in lieu of using the cash flow from the investment. So that's another way to do it. The worst case scenario is that you use the passive losses that you've accumulated over a period of time. When the property sells, you're able to take that entire carryover loss in the year it sells. And most of the time, it's used to offset some of the capital gains on the property from the sale of the property. So it's a really valuable strategy. And what I tell people, here's a little extra one for everybody, right? If you're in that boat, right, well then every year you should be allocating some of your ordinary expenses that you're paying anyway, allocate them against your K-1s. Take a portion of your cell phone. Take your business miles for if I'm going to meet with Vinney, I'm going to a meetup where Vinney's speaking and I'm going to learn all about syndication. Well, those miles are tax deductible. Miles spent looking at properties, the phone calls I make for due diligence, a piece of my internet, the travel to conferences and network, the educational events, all of these things I can apply against my K-1, right? As additional unreimbursed business expenses against my K-1. Now, so let's say, for example, I'm able to use $2,000 a year. I'm able to convert $2,000 a year of things I'm paying for anyway, and convert them to deductible expenses against my K-1. Well, after 5 years, I've got $10,000 more carryover that I can use upon the sale of the property. And what's awesome about that is because you're not able to take the deduction in the year that you actually take the expenses as deductions, there's no worry about getting audited. So as long as you're reasonable about it and you put these amounts on there, down the road you can't get audited on something that's already been approved by the IRS and is older than 3 years old, right? So these passive loss carryover, these sort of add-ons to the passive loss carryover are basically audit proof.
Love it.
Yeah,
Oh, that's
so
awesome.
it's a great strategy.
What great, beautiful nuggets you've been, sharing, guys. I mean, I'm telling you, please make sure that you pick up, Ted's book, and of course, give him a call, have that, 15-minute meeting. You will really learn so much, and Ted can help you, with the tax strategies. How about then in one asset, if you're accumulating passive losses for next 3 to 5 years, and let's say we have X amount, and now we sold the property, right? So we have to capture the depreciation. If we got the accelerated depreciation effect, right, Ted? We have now lowered the basis, we call it, because we bought the property and minus the depreciation. It's got lowered the base, and then we sold it at this price. Now we got a bigger capital gain. A lot of people ask me, oh, aren't we going to capture that? You're right. We are going to capture that. When it's not the ordinary income that they are paying taxes on, it's the capital gain. It could be 15 or 20% long term. But is it true that we can take the whole capital gain for the investor and bat it against all the accumulated which we didn't use?
Right.
Yeah, that's what I meant. Yeah.
Well, the first part of it, because most of that carryover came from the depreciation that you took, right?
Yeah.
But there's also another portion that came just from operating losses of the other operating losses of the property, over and above the depreciation. Right? So you're still getting cash flow. You've been getting your cash flow, and now you're gonna the loss carryover is going to completely wipe out the loss. It should wipe out a capital gain, especially if you're doing that tack on that I told you to do just now, right? Now, So that really is going to be very, very beneficial. In the worst case scenario, you'll have a small capital gain on the sale of the property. Again, 15 to 10%, and you made money, right? And that's the big, that you don't have the capital gain if you didn't make money.
Exactly.
So I want to be clear about that. You're paying taxes because you made money, right? Now, we kind of skipped over one of your other questions, which was real estate professional, right?
Yeah.
So with the real estate professionals, they have a little bit of an advantage. Now, a real estate professional, okay, is somebody who's active in a real estate trade or business, right? So they could be a real estate agent or broker, a developer, a landlord. They could be in the syndication business. They can be in property management. There's a whole bunch of different businesses that qualify for real estate related trade or business, right? Now, in order to qualify, you need to have at least 750 hours a year in that trade or business. And it has to be more than half of what you do in total, right? So if you're a doctor, right, working 2,080 hours a year, 40 hours a week, 52 hours, 52 weeks a year, it's very difficult to qualify because you would have to work 2,081 real estate hours, right? So most people I don't think there's a bigger red flag, okay, than somebody who has a full-time W-2 job who's claiming real estate professional status.
Yeah.
Unless your spouse is the one who's qualifying as a real estate professional. Because your spouse could be the doctor, lawyer, engineer, Indian chief, whatever you're doing, right? Working your W-2 job, making nice money. And your spouse is a real estate agent.
Correct.
Great. Awesome. The spouse qualifies the joint tax return.
Yeah.
In order for you to declare yourself a real estate professional for being able to deduct the losses, right? Now, there's a couple of really important considerations here. And the one we were talking about before about foundational items like documentation, right? So 2 things. One, if you're going to be in a real estate trade or business to take real estate professional status, to me, you should be making money doing it, right? So I want to see my real estate professionals actively running a real estate business. So if you're a real estate agent, you should actually not only be logging like all of your real estate agent related activities, right? If I'm a property manager, same thing. I'm documenting, hey, I went to 123 Main Street and collected rents today. It took me an hour. I called the plumber for 123 Main Street. It took me half an hour. All of the various things you do with, this is the property I worked on today, or this is the property I'm discussing. This is the person I called. Here's how much time it took. Here's the day, right? Being as specific as possible in your documentation, right? And you can even standardize it, because think about like some of the things that you do in your business. I'm sure there's a set of activities that you have that you do almost daily, right? And you can just kind of lay them out on a spreadsheet and then just plug your time in every day with a description of what property you were working on or whatever. It's pretty easy to lay out a spreadsheet. And I have sort of a mock spreadsheet that for people that they can expand and design on, right? Now, I want you to be making money. What things help? Well, if you're, say, a property manager, getting paid from your client is a good, start, source of income. If it's real estate agent, I want to see commissions. If you're a developer, I want to see, projects. If you're a property manager, I want to see clients, right? Things you're managing. The other thing with the documentation is just making sure that you're documenting all of your time, all of your various activities. And at the end of the year, we're going to make an election on your tax return to aggregate all of those activities into one primary activity. So because as a real estate professional, I might be doing a little bit of agent work. I might be doing a little bit of property management. I might have my own portfolio, right? And what the IRS would say is if you don't make that aggregation election, then they actually want you to have 750 hours per activity. So each rental property, in theory, could be its own activity.
Yeah.
right? So you have to make that aggregate election. And in order to say all of this is one big real estate related activity. Now, so here's some of the no-nos, right? Just we'll cover them real quick. So I do have people who come to me and say, Ted, I'm a real estate professional because I spent 750 hours this year traveling the globe going to real estate conferences. Okay, well, did you make any money? No. Okay, doesn't qualify, right? Now, there are some people though, right? Let's say I'm a syndicator and I'm running meetups, right? And I'm educating people, and I'm also going to educational events in order to learn more information so that I can do my meetups and educate people, right? And I got an acquisition fee that year, right? Okay. Well, now I've earned income, right? Now I can start including some of my education in there, as part of because my education is part of my business.
Correct.
Just running around getting educated is not a business unless you're using it to make money.
Yeah.
Right. So those are some of the things that that I talk about, and I really have to warn a lot of people sometimes that you just can't fill out a piece of paper and say my spouse did all of this, but there's no money there, right? Yeah. That's going to get you flagged.
That's so true. Thank you. No, it's so valuable information you're sharing, Ted. We really appreciate you coming on the podcast, and it's going to be very, very helpful. What are some of the other things that you find mistakes the individual or LLCs make, when they come to you and you say, oh no, this is not right. This is not right. What are common mistakes, if you might tell us?
Yeah. There's a few. So the first most common mistake is the phone call that I get every once in a while. Hey, Ted, I just sold my property, closed on it a couple of weeks ago, and I'd like to do a 1031 exchange, right?
And you're already past that point.
Right, exactly, right? Nothing I can do to help you with the exchange. Now, there's some other strategies we can use to help offset, but a 1031 exchange has to be set up before you sell the property.
Right. And it has to be a rollover completely.
Yeah,
right, exactly.
5 days before you have to tell the 3 properties you're going to transfer to, right? Is it?
Right. You have 45 days to identify after the closing. You have 45 days to identify and 180 days to close. But before you ever close on the property, you had to have that whole situation sort of set up so that the money from closing went to a qualified intermediary. You never touched any of the money. The other one that I get is, what can I deduct? Right? And I get that one so often, right? That I actually, as part of the Tax Smart Landlord book, in the back, there is checklists here of, there's checklists that say these are deductible expenses for rental properties, and these are the administrative expenses related to rental properties that most people miss, right? And the things that most people miss are the same things we were talking about before: mileage, education, travel, meals, all of these kind of administrative stuff, because it's not the mortgage interest, it's not the real estate taxes, right? It's all the sort of kind of soft kind of costs that you have as administrative stuff as an investor that most people are missing. So what I do when I do somebody's taxes is I send them that checklist. And I say, have you thought about these expenses? Right? Because those are really important. Those are the ones people miss. And the feedback I get on that is amazing. Nobody's ever done that, Ted, before. Nobody's ever asked me about these expenses. I had no idea because nobody's ever asked me. Well, that's the benefit, part of the benefit of working with somebody who's real estate specific, right? And so those are the kind of the bigger mistakes that I see people making. The other one I have to say, people doing their own taxes. If you're doing your own taxes, I can guarantee, unless it's just a W-2, you're just filling out your W-2 and sending it in. If you're a real estate investor and you're doing your own taxes, I guarantee you will leave your money on the table.
I think so. I think so.
Leaving money on the table.
I've been guilty of that, you know.
For sure.
I was going to ask you also about leasing a car, an office car, or buying an office car. I know some of my friends, we were debating, right? Which is better for the taxation? Like I do have my wife and I, LLC that we operate. So what's better? What's better from the taxation perspective?
Right. Okay. So what it really comes down to, right, is how much of this vehicle am I going to use for business purposes?
Yes.
Right. So if I have, so the easy example is a contractor who has a pickup truck, right? And he leaves the house every morning in his pickup truck and he goes and he does contracting work all day and he puts his tools back in his truck at the end of the day and he comes home. And he literally uses that truck pretty much 100% for business. In that scenario, buy the truck, buy the vehicle, take the full expensing in year one, either bonus depreciation or Section 179 depreciation, either one, and move on. Now, when you get into something a little more esoteric, say yourself, who maybe is using his car to run around to different meetups, do different events, but you probably aren't driving, without knowing what you drive, but you're not driving you're not driving a pickup truck or whatever. Mm-hmm. You might be driving an SUV over 6,000
pounds. A nice car, a BMW.
Right, yeah. But so a nice car, like a nice BMW, right? That's considered a luxury auto, right? And that's not subject to the same deduction capabilities as, say, that pickup truck that the contractor has. Yeah. And let's say you're only using your vehicle 50%, 75% for business, right? So let's say it's 75% for business, okay? So now you can take, there's a luxury depreciation limit, right? Correct. So you do get depreciation on your vehicle, but it's limited, right? So now whatever that limit is, you can take 75% of that limit, right? So let's say the limit is $15,000. I think it's $18,000 in year one, actually. So it would be 75% of 18,000 would be your depreciation. And then you would deduct also your actual expenses, 75% of your fuel, 75% of your insurance, all the way down the line, right? Which means that you need to be keeping track of your actual expenses in your business, right? Now, let's say I'm below 50%. Let's say I'm only at 30%, right? Yeah. Well, now I might be better off just tracking my miles. Yeah. Right? Because I'm not getting that depreciation. Mm-hmm. And so now I'm just going to I'm going to use the standard mileage methodology, and I'm going to say, okay, I drove 25,000 miles in my new BMW this year, and 7,500 of them were for business. So I'm just going to take 7,500 times 58 cents a mile, and that's going to be my deduction. Nice. Right? In that scenario, you might be better off leasing. Yeah. Right? Why? Well, I'm going to say this. In a typical scenario like that, you might be better off leasing. The only thing in that scenario that would keep you from leasing is you don't want to be driving a leased car 25,000 miles a year, right? That's going to kill you.
Yeah, I know.
But let's say you're at 12,000 miles a year.
36,000, I think, right?
Right. Yeah.
They give you
that's the other consideration with leasing. How many miles do you drive? Because if the answer is anything over 12 to 15,000 miles a year, you need to buy the car because you're going to get creamed on the lease, right? So there's other alternatives. There's other decision-making criteria on that buy versus lease. But it's a no-brainer for people who have 100% business usage vehicle where it's either a truck or a heavy SUV.
Wonderful, wonderful. No, thank you so much. Boy, you have so much knowledge. I really appreciate that, Ted. And I would really highly recommend, guys, anybody listening, and reach out to Ted. So Ted, how can people reach you? How can they get to?
That was going to be my next question.
Yeah, I know. Alicia's been kind of dozing off there. No, I'm here.
I'm good.
No, I was watching her.
She was I like to know about how to save money. I love it.
Yeah, she was paying attention, Vinney. I was watching her.
I know.
So, anyway, You can reach me. My office phone number is 203-922-1742. I'm usually in the office, especially this time of year, and with with what's going on in the country right now. I've got nothing else to do but work. So office 203-922-1742. My email is ted@lanzarocpa.com, and I'll spell that for you, LANZAROCPA.com. And that's also my website, which is www.lanzarocpa.com. You can actually get a free digital copy of the book on the website, and you can also make an appointment. There's a section called Work with Ted, and you click on that, and you can tell me a little bit about yourself and set up that 15-minute appointment right on the website at www.lanzarocpa.com.
Oh, that's wonderful. No, thank you so much, Ted. And we put them in the show notes, right?
Yeah, I'll put all your contact information in the show notes for sure.
That sounds great. Thank you.
That's very kind of you that, that you could give the PDF copy. I would highly recommend, guys. I know a lot of time it's good to read and so forth and highlight, some of the points of the book. So, get a free digital copy, but also get a paper copy. Again, to reach me, Vinney Chopra, as you know, you can always text anything to 474747. So that's the texting, 474747. Write your life story. No, I'm just kidding. Or you could just say learn, LEARN, to 4747. That's just like the jumbo jet, right? 747. I took the 7 out. So 474747. Or if you want to invest with us, invest 2020. But like I said, you could just write us any note, and you can email also John, my VP of the Academy, and also partner now in the business. And Alicia, she's my marketer. I mean, many of you have seen the book. It took me 2 years to write, just like Ted was saying, and it's been an international top seller. We just launched the Spanish version of this book also on Amazon. We have it in digital, the Kindle edition, and also the audio. So there are 4 different ways you could have that. Ted, it's been such a pleasure. You have been just a great friend, and thanks so much. And I appreciate giving all the golden nuggets, and we'll do it again, hopefully. And maybe we can have more questions our audience will ask us, and we'll get you back on there. And thanks again, and appreciate your time this morning here.
Vinney, thank you so much. It was my pleasure to be on, and I always appreciate all of everything you do, and you're doing some great things out there. So keep up the great work. Thank you.
Oh, thank you. God bless you, and stay safe, stay healthy. And Alicia, anything you have to add?
Well, guys, don't forget to like, comment, and share. And this is Syndication Made Easy with Vinney Chopra. I'm your co-host, Alicia DeBrell.